Good afternoon, everyone. Welcome to our Short Verticals webcast. I'm Connie Hill, sitting in for Brett Crowther today. I have a question for you. How many of you have a go-to watch list for your short verticals? Meaning you know where it is, you can pull it up, it's up to date, and you know if you look at that list, you could find some sort of trade off of that list. Well, if you don't have something like that, by the time we're finished today, you will have something like that. And I'm going to show you a pretty quick and easy search to get some stocks that you could use for short verticals. Now, I'm happy to see so many of your names here in the chat. Welcome, those of you that are, I'm going to consider our veterans, and we have new folks joining us all the time. Welcome to each of you. We also have the pleasure of having Kevin Horner in our chat today. Kevin's a 20, maybe 30 plus year veteran of the markets, maybe 30 is too much, 20-year veteran of the markets plus. He knows the markets inside and out. He knows what we're talking about today with these strategies. So as you have questions, go ahead, chat them in. I'll keep my eye on the chat. And if there's something I can't quite get to, Kevin will help us out there with those questions. If you're listening to this on the recording and you have questions, go ahead and put your question in the comments section in YouTube. So I'll go back, I'll review those throughout the day. Make sure you get your questions answered as well. Hope you're following us on X. I'm Connie Hill CS. Kevin is Kevin Horner CS, and we'll post educational content out in our X account as things happen in the market. And we noticed that we'll share those little tidbits with you. So follow, it's free, nothing really to do. Now, I'm going to see if any of you answered me in the chat here that you felt like you had a watch list, a go-to watch list. And I'm not seeing anybody that says, yes, of course, Connie, I have that. I absolutely have that. But at the end of our session, you would be able to say that. Okay, let's go through our disclosures and get on with our agenda. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for information and educational purposes. Don't consider it a recommendation. We'll be using the Paper Money software application. You'll download this to your computer. It's the most robust version of Thinkorswim. And it's nice to be able to use that paper side of it so that you can experiment with rules, so you can experiment with strategies as you're building your comfort level. Fantastic place to do that. There are some differences in Paper Money and the live market. Short options can be assigned early. At any time, I shouldn't say early, but they can be assigned at any time up to expiration, regardless of the in the money amount. Paper Money does not assign early, so that is one difference you want to be aware of. Past performance is no guarantee of future results. When we talk about probabilities, which we will in this class, keep in mind they're theoretical in nature and are not guaranteed and do not reflect any degree of certainty of an event occurring. All right. We're going to talk a little bit conceptually about short verticals. Today, we're really focusing on what kind of stocks are good to use for short verticals. And then we'll talk, we've got several trades I've got lined up for us to discuss and talk about monitoring them, how we would approach them. And of course, we're going to be doing some example trades here. Now, when we're talking about what you might consider for a good candidate for a short vertical, I hope all of you just kind of can have this roll off your tongue, okay? We're looking, if we're doing a put vertical, then we're a little bit on the more bullish side of things. So typically we'll look for the trend to be more bullish, but it can also be a neutral trend, and that could work out just fine for these kind of trades as well. We're looking for stocks that have the higher trading volumes, lots of activity. When we have a high trading volume in the stock itself, that is means it's more likely that we'll find options that have a lot of open interest, that have a lot of contracts out there exchanging. And so it makes it easy for you to get in and out of the trades. We look for something that has a tight bid-ask spread, which means not a big difference between what the ask and bid price is of that option. I mean, we'll look at some, and if it's like 10 cents, 5 cents, you're like happy camper. Every once in a while, we'll get something that's like 2 cents, which is really, really nice. But we're trying to not get engaged in stocks or options that maybe have a wide spread, even if it's just temporarily that it's wide. In fact, some trades potential trades I looked at as examples here today, I tossed them out because for the moment, the spread, although not common, was a little bit wider than it usually is. All right. Let's hop on over to our Thinkorswim. Let's start with the scan I want to show you, or search, so that you can build a watch list of candidates. Let's head over here to the scan tab. And I'm going to reset this. Actually, maybe I'll just leave it on. It's really not a complicated scan at the moment. Well, I'll do it from scratch. All right. First thing we want to do is have a price of the stock. And I have a tendency to use the last price. That seems to work out really well. But if you wanted the closing price, the highest price, whatever you want, you could put there. But we're just looking at prices of stock. Now on here, we're going to put a minimum of 20. When we're looking at bearish trades, typically I like them to be at least 40 or higher, because I want there to be some room for the stock to drop when it starts to show that weakness. I don't want it to have been dropping, have hardly any left to drop. However, for this surge, because we're going to use it for both bullish and bearish opportunities, we're going to just put it at 20. Okay. Volume is today's volume, so we're going to do something about that, but not with that variable. What we're going to do is we're going to come over here and add a filter, and we're going to put on a steady filter. As a reminder, steady filters do not work in your paper side. They only work on the live side. So if you were going to create this scan, you would need to build it on your paper side, run it, and then share the watch list. Just copy that URL and then import it into your live site or your paper side of things. Now, the study that we're going to use here, we're going to come down to volume, and we're going to choose average volume, so that it's going back and looking at previous periods as opposed to just today's volume. And so we're going to put this on 20, meaning we're looking for what the averages have been on these stocks over the last month or so. And we're going to put a value here that might be a little higher than some of you might be used to using. We're going to put it at 2,500,000. Now, sometimes people, when you're looking for options type stocks, might start at $1 million, and some people might raise it to about $1 million too. For this to be our ultimate watch list, we want it to be trading over 2.5 million shares on average, so that we can hopefully find the liquidity in the options, lots of open interest, bit tighter bid-ask spreads. And so that's how we're going to funnel it. Now let's go ahead. I'm going to choose up to 2. The scan is not complete. I'm just going to run it and show you something. Then we're going to add a couple of more filters. So let's go ahead and hit that scan. It looks like it brought us back 514. Well, that's a whole lot of stocks to poke through, isn't it? What we're going to do is add a couple of other dimensions to this scan. So one thing we're going to do here, we're going to scan, right now it says all stocks, but we are going to come down to a public watch list. We're going to grab the S&P 500. Okay. Oops, I grabbed the wrong number. Let's get that again. S&P 500. There we go. And then we're going to do an intersect with. We're going to intersect this with another pre-built list that's called penny increment options. And those penny increment options typically have tighter bid-ask spreads on them because they're trading in penny increments as opposed to 20-cent increments or 50-cent increments, 30-cent increments. Usually it's because they're trading in penny increments. And by using both of those pre-built kind of lists of stocks that are available, it does a lot of nice weeding for us. So instead of having to sift through 514, we go ahead and hit scan. We're getting back about 134. Now that's a pretty good size watch list. It might be a little bit too much for some of you, so you might do some further weeding. If you wanted, you could come over here. You could sort by volume. And then maybe you just pick the ones that are over 5 million on average. This is actually today's volume. It's a little bit later in the day, so it is a little bit more representative of average volume than if we had been doing the scan first thing in the morning. Okay, so there's 134 stocks. Now there's a variation to this scan if you wanted, and that is in we won't take the time to do it, but we could scan in the NASDAQ 100 as well and get a list of stocks and bring both of those lists together. Okay. For today, what we're going to do is I'm going to save this watch list out here. We're going to give it a name, and I'm going to call it liquid options with today's date. Let's get rid of that cap. Let's try this again. Liquid options. And today's date is May 7th. So we're going to put 5/7 there. And how long could we use this list? You know, we could use it for a month. We could use it for 6 weeks. We don't need to go refresh this watch list every day, not even every week, okay? Because the stocks are going to stay pretty much static because they're meeting a certain criteria that we're looking for liquidity. We're not necessarily looking for trends. We're not looking for them to be above a certain moving average because we're going to use this for bearish stocks as well. All right, now I'm going to go and open our watch list here. This is an earlier one. And this is, we're going to come down here to personal, and we're going to find liquid options 5/7. All right, I'm going to go ahead and bring that up, and that is our watch list. And then what you can do, you can sort this however you want, but typically what you might do is just come over here to a chart. I've got these lists linked, meaning I've got one in a red box here as the color I'm choosing to link to and the number, and right here on the liquid options watch list as well. So when you have them linked, it just makes it really easy for you to just walk through the different options that are there, take a look at the chart, say, gee, do I have a bullish entry? Do I have a bearish entry? Do I have a no entry? There's no entry. We just move on to the next stock. Okay, nothing is there. We move along to the next stock. And really, I wouldn't expect you really to go through all of those stocks. What you might do in a given day is if the market, say, is down and you're looking maybe for some bearish positions, then maybe you sort the watch list. Actually, the way it's sorted, but just the opposite. Let's sort it with the negative values on top, put it in descending order. So we can see, okay, the stocks with the most the highest percentage down will come up on the top. And it doesn't mean they're all going to be bearish stocks, but just on the day they might be bearish. You can see Western Digital, it's been a super bullish stock. It looks like it's just having a down day. That doesn't mean, oh, gee, we could only look for it for bearishness, but we could look for other opportunities, you know, just depending on what the technical setup is. So if you've got this list and you can just go to it, if you get comfortable with it and just that process, then you can find some trades in pretty short order. Now, each of the trades that we're going to be doing here today came from this watch list. Okay. Oh, it looks like we've got a survey out there. And they'll put surveys out there from time to time. I don't control it, nor does Kevin. But some other powers that be that work with our webcasts. And if you haven't seen a survey before, it's a really easy survey, and I can do easy surveys. It's 2 questions. They're just on a scale of 1 to 10, what is your feeling about this? What's your feeling about this? Fill in the radio button that corresponds. And then there is a place for you to answer some questions like, you know, what topics would you like to see addressed in this class? And I encourage you to use that space to write something out. If it's my class, to me, since this is usually a class that Brett teaches, if you want him to cover something, go ahead and let us know, and I'll make sure that Brett gets that information that you'd like to see it covered. So it's a way that you can communicate with us when sometimes it's not that easy to communicate with us, right? We have limited ways that we can do that, but this survey is a way that you can do that. So we always appreciate you taking the time to fill it out. Kevin will post it a few more times while we're sitting or while we're here in our discussion. And I'll remind you at the end of our class as well. So we always appreciate it when you take the time to do that. Wacky Whack, you are on the ball. Yes, you've already got it done. Now, Jim says, what SMA can we use to determine a good entry point? Well, we haven't talked about entry points yet, but whatever you use as, say, a bullish entry, you might do that. If that means that you like the stock to be above a certain moving average, great. On our chart here, I have a 10, which is the blue line, and a 30, which is this red line. And then I just have the RSI. It's a good gauge of momentum and what direction that momentum might be running at the moment. So when it's headed down, it's a little bit more on the bearish side. When it's headed up, it's usually on the bullish side. There can be some exceptions to that, which we won't get into, which are some ranges the RSI has a tendency to trade within when it's bullish and when it's bearish. But for our purposes today, something like APA had been running up really nicely, right? Had a really pretty decent sized pullback. With the price of oil dropping yesterday and today, it's really pulled back and put in a lower high. So I would say just because the price is down below the 10 and the 30 doesn't necessarily make it have an entry. Okay. Let's see. Did they announce earnings last night? It looks like they announced earnings. And that's the result of their earnings. We're seeing that being manifest today in that nice little gap down. So we won't necessarily say, oh, just because it's wherever you might have an entry related to a moving average. However, you might say, normally I would like it to be above the 50 moving average, for example. And then you might look for a hold, which is a close above the high of the low day. You guys, a lot of you probably have that memorized and know exactly what that is. If it's a bearish trade, you might look for a close below the low day in a stock that's been downward trending. You can look at a breakout of a price pattern like a triangle or a flag. Those can also be really helpful, useful entry points. Okay, so something that is bullish that you like to see, maybe it's a bounce off a moving average, maybe it's a bounce off support after a little pullback. Whatever that might be, are entirely great things to be looking for when you're just reviewing the charts here. All right. Wacky's been talking about some golfing today. And, I am not a good golfer, but I do like to golf. And we're just finally getting to some weather. We can do that now. Yesterday in Denver, Kevin had snow, so he's probably not going to be out there golfing at his resorts quite yet. He needs some of that snow to melt away. All right. Let's take a look at our first stock that we're going to use here today, which is KO, Coca-Cola. They made it through their earnings. Looks like the market liked what they had to say because they had this nice little gap up. And it's really stayed pretty decent in this range over the last few days. Let's go ahead, maybe just put a line in here, maybe representing kind of an area of support here that the stock really just hasn't been going below. Today, it looks like it came down and touched it and tried to bounce back up. Now, if something's going a little bit more on the bullish side, then we'll look for a short put vertical. When we're talking about entries, sometimes with verticals, say a short put vertical, sometimes people like to get in at support. Sometimes they might not wait for the hold or wait for the bounce. They might just say, gee, it's sitting at support, and all I'm going to need is the stock to stay above a certain level, and they might use that as an entry point. So even though a lot of the market's pulling back and a lot of stocks on our watch list are pulling back, Coca-Cola, it's pulling back just slightly here, about 45 cents. but it's sitting there at support. So we are going to use this for a short put vertical. Now, as we come over here to the trade tab, and we see all that are available here. Stocks traded 7.6 million shares today. Lovely. We love to see that, right? It has weekly options available. Now, not all weekly options are going to be super liquid. Sometimes they're just not. Coke is actually not too bad. But if, say we look out, say 30 days-ish, that would be, say, June 5th. You know, a time frame people like to sell verticals many times could be 20 to 40 days, okay? So this is just kind of at 30 days, kind of in the middle of that range. Sometimes people might look for that. As we look at the open interest, here's the open interest on the call side. We'd be using puts. We talked about a short put vertical. And some of them have a lot of liquidity and some of them don't as much, right? 26 contracts here on that 78. We got 143 here. We've got 461 there. So this actually is a possibility. If we have the strike prices line up with a lot of liquidity, then it could turn out that maybe we could use it. If we don't have it though, don't hesitate to just go out to wherever the monthly options are. In this case, June 18, and you look at the open interest here, you're like, oh yeah, that's a lot more open interest. There are a lot of fish in the sea out there. And those are the kind of contracts we want to deal with are the ones that have that liquidity. Okay, so we are going to use the monthlies for that purpose. I wouldn't fault you if you wanted to use the June 5s and the June 12s, as long as there's enough liquidity for however many contracts you need to trade. You know, if you're trading 1 or 2 contracts, maybe even 3, you'll probably be just fine. But if you're somebody that likes to trade 10 or 20 contracts at a time, you really want to be looking for multiple hundreds and into the thousands if you can. Okay, any questions on that? If so, let me know. Now, let's go construct the short put vertical. I'm going to use my delta column to help me identify the strike price I might want to sell. Now, we've got a 58, we've got a 38, we've got a 22, and a 12 that are probably the prime ones to be looking at, okay? Usually people on short verticals like to construct it. You don't have to be conservative, but they like to construct it a little conservative and sell something out of the money and then just buy the next strike price as the hedge. Sometimes you might spread the strike price out a little bit. But on this one, I was looking to do here, let's see if this still makes sense. Yeah, 77.50 and 75 were the strike prices I was looking at. So we're just going to say sell vertical, starting on the leg that we're going to be selling. And it looks like it's going to generate a 70-cent credit here. Now the question comes up, well, is that a good enough credit? Is that a good enough credit for you to consider selling this? So we're going to just grab our calculator here. Our max theoretical gain is 70 cents per contract, no more. But the difference between the 2 strike prices, which here's 2.5, minus the 70 cents gives us what our max theoretical loss might be. Okay, so take 2.5 minus 70. That's going to give us $1.80. So we are willing to risk $1.80 to make 70 cents. And on these short verticals, many times that's the way that it'll end up. You are more interested in, say, the higher probability than what the actual return is, right? What is the probability that this 57, where did it go? 77.50. Let me scroll down a little bit. There we go. What's the probability it would be expiring out of the money? Well, we can use this probability OTM column, and that's pretty dang close to 60%. Generally, 60% and higher is what we would consider higher probability. So kind of checks that box. If somebody was not comfortable selling the 77.50, they could come out here to the 75 and sell the 75 and maybe do the 72.50. The return is going to be significantly less, but the trade-off is the probability of having that trade come to fruition or being successful for you. You know, 76 is a higher probability than say a 60. All right, so you're weighing that trade-off, you know, whatever the credit is and whatever the probability of success might be. Now let's do something on this one. Let's figure out, and maybe I'll just write on my scratch pad here. I'm going to write 180 is going to be our max loss, and let's figure out what percent return, because sometimes that's what people will do. They'll say, well, if it's a good enough return, then I'll follow through with it. So if 180 is our max theoretical loss, our max theoretical gain is 70, we're going to divide our 70 by our $1.80, and that's about a 38% return. So there might be some of you that say, yeah, I always want to get at least 30%. Some that'll say, well, no, I like higher than that, like I like 40 or 50%. And remember, your trade-off is that your probability will be lower, but they're theoretical in nature. It's not a guaranteed situation. But this would probably fall in a range that many people might be happy with this, okay? So we're going to go ahead, we're going to put it on. Now, if we can risk 180 per trade, typically in a class I'm doing, we risk $2,000 per trade. So if we have $2,000 and divide that by 180, we can do 11 contracts. So we're going to do 11 contracts in here. We're going to bring that up. And then what we're going to do a first trigger sequential. We're going to create an opposite order. And there's a number of ways you can do this. You could do one cancels other order, put a target and a stop in. For our purposes here for right now, we're just going to put in a target. If we get a certain percent of this 70 cents, we're going to be happy to take our gains and step aside. Okay, so what if we get, say, 70 cents? What if we can get a 65% of that? You comfortable with that? Some of you are happy at 50, some of you are happy at a little higher number. Let's go 65 on this, which means 35% would be less if we got 65. Let's say times 0.35. That says go buy it back at 24. So that's what we're going to do. We're going to let this sit out there. And if it meets that condition, great. What else are we going to do with it? Well, we're probably going to have to be a little bit patient with this. It takes a while for time decay to really develop. We're going to go ahead and send this in. And remember, it's the 77.50 that we want it to stay above. So if we come out to the chart here and we go 77.50, good, we got filled real quickly. The support down here is 77.95, so 77.50 is going to be a bit below kind of where I drew in that horizontal support. It's nice if we can sell down on the other side of support, okay? Because you kind of have a barrier there, and we want the stock to stay above it. So if it goes flat from here, we're happy. If it goes up from here, we're thrilled. It could even come down a little bit, right? It could come down to support. It could come down a little below support, and it still could work out to be a favorable trade for us, okay? But we do have to use some patience there. All right. All right, let's look at another one. Another stock on this list is Dollar General. Let's look at Dollar General. Some of these stocks have, their retail stocks have been having a harder time, okay? And on this, we can see, gee, it looks like both the moving averages are moving down. Looks like it tried to rally up. Oh, it tried to rally up and it just could not get that far. And what did it do? It just is kind of pulling back. Now it is up, it looks like 56 cents at the moment. But on this one, we're going to do a short call vertical. We're going to look for the price of the stock to stay below a certain amount. Now, earnings are out here. We probably could be done with this trade before earnings on June 2nd. Okay, that's a possibility. Let's go ahead and take a look at the trade tab, see maybe what things are looking like here. So Dollar General's traded 1.73 million shares today, so not shabby. And we know already, because it came in on our search, that it trades at least 2.5 million on average. And it does have some weeklies. Now I'm going to go out and test these that have 29 days and just kind of take a look at the liquidity, especially on the call side of things, looking to do a short call vertical. So if I look at the open interest here, I'm looking at 9s, 2, ooh, this is a good one, 513. But coming out into the 30s, which is where we might theoretically start with a spread here, this is pretty low open interest, okay? And so you want to pay attention to that detail. You want to go, not so many contracts there. We're not going to use the June 5s. You can pick through the others, see if there's something there, but we're going to go out to the June 18s where the monthlies are. And then we can see, oh yeah, lots of open interest out here. We're looking at several hundred to several thousand contracts. That's the kind of place we want to be. So again, 20 to 40 days worth of time. It's a little bit over, but it's not, and it's not terrible, and it's not a bad thing. It's in that general range, just a little on the high side of it. And sometimes you have to go out 50 days just because of how the strikes pull out there. Now here, if we say, all right, where's our delta? Our delta represents a couple things. One is, what is the likely price of the option going to move when the stock moves $1? So stock moves $1, Dollar General is going to move in the neighborhood of about 36 cents, okay? We can see what is the probability of it expiring out of the money here. And look at this one. This one's 69%. So that's higher than what we saw on Coke. On Coke, it was like 59. For something similar strike area, it would be 69%. And we would want the stock to stay below 125. Now, some like to go to the chart at this point and say, well, where is 125? Okay, and I'm going to come in here and draw the line as close as I can to it. It's going to have to be close enough right now. 125 is up here. So it's been below 125 for several days here. And more recently, when it got up here, it got up a little bit higher than 125, but it's been trading significantly below it. So in this case, this stock can run up a little bit if it wants, right? It could kind of mosey on up. It could even cross over and then pull back. Still could work out being just fine. If it goes flat, would work out just fine for us. But if it were to drop, that might put us in a position of being able to lock in a large percentage gain more quickly than if it maybe goes up a little and pulls back, right? Then we might have to be exercising some patience. But really, we have plenty of time out here before the 2nd of June. So we're not going to be concerned about it, all right? So 125 on the call is right about here. So 380 by 435. Now this is a little bit wider than what I would like to see. So we're going to have to try to get filled at the midpoint prices here. Let's go ahead and we're going to say sell vertical. And it's going to bring in a credit of 135. Let's go ahead and just kind of lock that in so we can work with that number. So we would be saying, all right, $5 minus 135, which should be what, 365. We're willing to risk 365 to make 135. And the probability of that trade coming off as right now is about 69%. So that's in the higher probability range. Now let's figure out what the return is. Going to go through these same steps again. We'll take 365. Well, actually, that's not true. We're going to start with our max gain. 135 divided by the max theoretical loss, 365. That gives us about a 36% return. So if somebody's comfortable with 36% return, great. For our class, we're happy with 36, okay, on that. Now, how many contracts can we do? We're willing to risk $2,000 per trade. We divide that by our max loss of 365. I should have put the extra ones in there. We could do 5 contracts, okay? No more than 5 contracts to stay below our $2,000 threshold. Now, let's do the same thing here where we put in a target, a profit target. So let's go ahead here. We're going to say, let's see, first trigger sequential, and we're going to create an opposite order. And we're going to decide where we would be happy. Would we be happy getting 50% of this, 60, 70? Let's on this one, let's go with 70%, okay? So if we get 70% of 135, then we know that 30% is left. So we'll multiply this by 0.3. And that says go buy it back when we get to 40 cents. Great, we're happy to do that, right? We will have collected most of it. And we're going to make that as a good till cancel. Now, some of you are going to say, well, what about on the downside? Okay. On the downside, sometimes people don't like to put in an exit on a spread like this because it's already a hedged position, right? We're selling the 125, and as our hedge leg, we're using a 130. So we kind of have some built-in protection due to the nature of how the trade is. And that's why sometimes people won't put in a loss. However, if this stock has a significant breakdown, let's suppose it's going along here flat, but let's suppose Dollar General has some good news, whatever that good news might be, and it starts popping its way up. Just because it comes up a little bit shouldn't make us too nervous, okay? Because the trade could still work out just fine. But suppose it had some fantastic news, and say it gapped up, say it formed a higher high. Then we're in a situation where we're seeing a technical reversal where we'd say, okay, technically it's not doing what we want it to do, so we need to get out of the trade. And we'll go buy it back. We'd be buying it back more often than not. It's going to be for a loss. But look how much wiggle room this stock really has to still be profitable. We're at 116. It needs to be below 125. So we're looking at about $19 there. That's a lot of leeway. Is that right? $19, $9, that's quite a bit of leeway there. Okay, so as we go ahead, we've got our 5 contracts. We'll buy them back at 40 cents. We're going to put this, go ahead and send this one off. All right. Now, I'm going to give you a quick plug before we go to our last trade. Okay, the quick plug is make sure you're subscribed to our Trader Talks channel. When you're subscribed, it just makes it easier to find what's going on in the day, right? After our class here, Mike Fairborn's going to be teaching trading with ThinkScript on Thinkorswim. And he does he intentionally has made this class not super difficult because he wants people to be able to kind of lean into and gradually start using ThinkScripts without creating some hairy big monster, okay? So he's going to be up next, and then new to investing is going to be Rachel. And she'll be heading up that class. This is definitely for super new people, okay? Not necessarily new to options, but new to investing altogether, okay? And I'll be there in the chat. She does a super job with that class, all right? So become a subscriber. You can find our stuff. Now let's introduce our last trade here. This is going to be on Capital One Financial. And if I back out here a little bit, you can see what's been going on with it. Had been kind of in a downturn, but it's interesting because the low points are getting a little bit higher. Like if I were to draw that in, but the high points are doing what? The high points are getting a little bit lower. So it's kind of in a triangle here. We'll want it to break out of here pretty soon, and the apex is getting pretty closer, so it's likely to. It could go either direction. Now, because they had earnings and they gapped up at earnings, the market liked what they said, they pulled back a little bit to support, but not a big deal. I could see somebody saying, I could do a short put vertical, I could do a short call vertical. Really, it's kind of sideways. And so maybe we could double dip. That's what we're going to do. We're going to double dip. I went ahead and drew out their short strike prices that we're going to use here. We're going to use 200 that we want the call side to stay below, and we're going to use 185 as the put contract that we want the stock to stay above. We're going to use these June options, I think it is. Look at the lots of open interest there. And so we're going to come out again to about a 30 delta. And I may have misspoke on that. We want the put to stay above 185. Maybe I said it correctly. Spread's not too bad, 20 cents there, lots of contracts. So we're going to do this. We're going to say sell vertical, and we're going to queue up that side of the order. We're going to put this in as a blast all. And we're going to treat this as two separate trades. Technically, you do two of them together, it becomes an iron condor. And sometimes people will put all four legs on at once. Because I want to manage it spread by spread, I'm going to put it in as two orders. But again, you don't have to. And we're looking here at that 200. I said, well, we want to see maybe the price of the stock stay below 200. And so on here, we're going to do a sell vertical here. Connie did that. Sell vertical. There we go. Get rid of that bullish one. And interesting, even though the spread is kind of in the middle, it is a little bit off. Okay, meaning they're not equidistant. And so we're getting a little bit higher credit on the call spread than we are on the put spread. Okay. Now, in the interest of time, because our time is almost up here, we're just going to do 3 contracts. Okay, so we're going to do a 3 on each of them. Theoretically, what could our loss be? Theoretically, we could lose on both of those spreads if we were terrible. I shouldn't say terrible. If we did not pay attention to the timing on it, theoretically, we could lose on both ends. However, if we're thinking, hey, this stock might just kind of stay between here, 200 and 185, we could possibly win on both sides. Okay, so we're going to put both of those in. And if I have an opportunity to follow up with these in another class, we will do so. They're not going to go to a bucket. We're just going to go ahead and send them off. And hopefully those are going to fill here in just a moment. Let's see, 5 and 10 wide. These are 5 wide here. You're right, that is a big difference. 210, it jumped up on us from, instead of having a 205, it's a 210. That is the difference maker. Good catch on that. Who was that? Who caught that? Somebody caught that. Anyway, good job. All right, you guys. So we've got 3 new trades in the hopper. If you're coming in a little bit late, there's our 2 on. Okay, one side got filled there. 2 on Capital One. Then we did Dollar General. It got filled already down here, and then Coca-Cola got filled down here. Okay, those are actually our 4 trades for the day. Now, I appreciate your being here. Appreciate you pointing out some different things related to these trades. Remember, if any of them have a technical breakdown, we're going to want to exit the trade. One thing I wanted to mention on Capital One is that if the stock, say, it drops down here, say it's hanging around the 185, what does that mean as far as our call spread? It means it might be in really good shape. It might be a good time to go buy it back. If the opposite happens, it comes running up this way. Well, we're going to manage that call spread or the put spread on the downside, that 185. You should probably be in pretty good shape if the stock is hanging up around there. Okay, so we are going to manage them by each vertical as opposed to the whole trade. Now we might get lucky, might get to keep both of those credits that we're sending in right now. Kevin, thank you so much for your help here today. Hope this has been helpful to you to just kind of see get a watch list that you can use, that you can look at it for both bullish and bearish opportunities. Use it for a month or so. I'll put the link to that in the description of the class, okay? For those of you that would like to use that. Appreciate your participation here. Now, who we got coming up next? We've got Mike Fairborn with using ThinkScript and Thinkorswim. It's a fun class. He'd love to have you join him there. We'll see you back there in about 15 minutes. Bye-bye.